I'm joined now by Alan Brown from Schroders. Alan, we just heard you on the panel talking about the death of the risk-free asset. What does that mean for a portfolio manager?
It's really very profound, because the risk-free asset lies at the heart of everything that we've ever been taught over the last 30 or 40 years. So we're really being asked to, if you like, rip up the rule book. It was Jim Grant in the United States, to give him credit, who said that government bonds, which used to be risk-free assets, are now return-free risk.
But do you think that something will replace them? There will become new risk-free assets, or are we going to have to redesign the whole of portfolio theory to have risk pretty much in every asset class?
Well, I think for my money today, government bonds face both duration and credit risk, and high-quality, high-yielding, cash-generating equities seem like a much better bet. There haven't been many opportunities in my life when you could buy, say, Marks & Spencer's on 3 times the yield of the government bond. I think that dividend is well covered. It will grow over time. The coupon on the government bond won't. I think M&S has better visibility over its revenues and expenses than the UK government. And unlike the UK government, its revenues exceed its expenses. So, in common sense terms, where would you want to be?
The risk of a severe dislocation in the markets as a result of a Lehman-like moment in Europe, that must give you some cause for concern as a portfolio manager. How do you manage that risk? And do you plan scenarios for it, or what is it that you do to mitigate the likelihood of the outcome of such an event?
It's extremely difficult to deal with these kinds of binary events. None of our risk models really help us. So in some sense, it's rather like flying low in fog with the instrument panel knocked out. And of course, it's not just the Eurozone. You've got things in the Arab Spring, potentially bubbling up again in Egypt, with Syria ongoing. You've got Iran. There's a lot of really difficult binary events. I think we have to remember that ultimately we're in the capital preservation business, so we can't assume that politicians are going to get it right in Europe. We need to see the evidence first, and if we miss out on the early stages of a rally in risk assets, well, so be it. I don't think our clients would thank us if we were in the middle of the heart of that problem when a crisis broke.
So where do you put your client? I mean, where do you like in terms of markets and asset classes for your clients at the moment? You mentioned equities,
yes.
But are there other geographies that you like as well?
Well, there are. I mean, I think the United States is a better place. They're not without their own problems,
no,
but it's a better place to be. I think there are other assets, and indeed bond assets, which have some attraction. So high yield would be one, and also emerging market debt.
And a final question, what do you think of the global borrowers? Is it a useful event for you?
Oh, I think it is. Yes, it's a tremendous collection of people you bring here, and the speakers, I hope, make a good contribution.
We're very keen on our speakers. Alan, thank you very much.
Thank you.
I have with me now Håkan Wallen from Deutsche Bank. Håkan, welcome.
Thank you very much.
Do you feel that the Euro crisis is the new normal for the market? I mean, it's been going on for so long that you must have got used to it in a way, and your clients too.
Well, I certainly hope that it won't be the new normal. We need to take a bit of a breather. This is a very complex and I call it mosaic almost. And all of these pieces need to be put together. And I'm actually, on one end, very happy that it takes some time, so we fundamentally set it up correctly. Because we need to have the sovereign as well as the financial and the corporate bond market working, and never mind the equity market and the foreign exchange market. And currently it's broken. So you have to take the time it takes democratically to get it right. It is painful, so it will be sort of the new normal for a little bit longer, I'm afraid, because it's not easy. But the payday, I think, is well worth it.
On the panel that you were just on, Alan from Schroders was talking about the death of the risk-free asset. What does that mean from a banker's perspective? I mean, if sovereign debt is not risk-free, how does that change the way your business works?
Well, it's a problem, clearly. It is a problem because when you have excess liquidity, if you have liquidity, you need to have somewhere in the liquid safe market, and that trust has been broken. So we see these imbalances, right, with extraordinary low yield in some countries, and it really market would benefit to have maybe that is a common bond in a few years' time, but it is an issue. It is an issue. And in those very low yield environment, then in those countries, creates not healthy incentives to maybe buy things that you shouldn't buy with your liquidity. which part of the reason why we got into the trouble in the first place. So it's a serious issue, and I think the Eurozone deserves and should have one large liquid risk-free treasury market equivalent, and it doesn't currently. And it's an issue, but hopefully that will be solved in time.
So, when you're taking non-sovereign borrowers out on a roadshow and introducing them to investors, how do you tackle the sovereign question? I mean, it must come up. Every investor must ask you, well, this is a Spanish company or a German company. How do you tackle that?
Well, again, you just literally have to, well, not again, you have to go through the details. The devil is in the details. You really, more than ever, need to explain your credit. Now, many of these very good companies in nations which have an issue around the sovereign ratings are global companies running phenomenally good business models, and you just need to make sure that you take time and that you get investors to be patient enough to listen through the story. And actually, many of that revenue or income may be coming from not that sovereign per se, but around the globe. But it's an issue, of course, and that just needs to be described properly and priced in properly. I don't see it necessarily as an issue. We have very many sophisticated investors, and they see through that, but you just have to do a bit more homework. That's all. It's just a bit more work.
A banker's doing a bit more work. When will you find the time? But in the recent cover story of Euromoney magazine, talking about the way that the DCM markets, businesses were being structured at the banks, they were looking at the new balance between flow business and more high margin structuring business.
Yeah.
How is that? I mean, has the way that you run your team and you run your business changed as a result of the crisis?
I'm not sure exactly what you mean with that, but
I mean, is it a different structure? Are you working with different people? Are the revenue streams different? Are the way you use balance sheet different?
Yeah, maybe. Okay, so I think in general, Wall Street or the financial industry is going back more to basics, right? So there may be less of the highly complex securitized product or other securitized product, etc., that is being worked on today. Some of that the pendulum has swung too far. We shouldn't throw out the baby with the bathwater, if you will. For example, asset-backed technologies are very helpful in package risk, etc. So I hope that pendulum maybe come back a bit. So yes, it's maybe a bit more back to basics. And of course, with derivatives going more on clearing and collateralized, there's less of the OTC business maybe than it was previously. But much of it, no. I think that's probably the best way to summarize it. Back to basics a bit.
Back to basics. Final question: Germany or Greece in the quarterfinal?
Germany or Greece?
Which one? You have to say.
Well, it's a tough one. I was in Greece over the weekend, and I watched a football match on Saturday. It was. They have a good team. It'll be a tough one. You know what? It has to be Germany, though. It has to be Germany.
Germany will save it.
Yeah, okay. I think it's Germany. I'm Deutsche Bank after all.
Well, exactly. You have it. Difficult. They're your clients.
But I want to be nice to Greece as well. They are good friends. Okay.
3-1 on penalties. Jolly good. Thank you very much.
Jolly good. Thank you very much. Okay.
I have with me now Moritz Kramer from S&P. Good morning, Moritz.
How do you do?
We were talking on the panel about a Lehman-like moment in Europe and a sudden dislocation in the markets that has, well, let's say, catastrophic effects. As a rating agency, how do you rate that? How do you evaluate the possibilities or probabilities of something that catastrophic happening?
Well, we had a few exciting moments already. We had a restructuring of the largest sovereign restructuring in the history, in the case of Greece. And we currently assign, still even after the election, over the medium to longer term, at least 1 in 3 probability of Greece leaving the Eurozone, if and when the program sort of collapses, which again is not a foregone conclusion, but it's a risk. So I think what has happened right now in the last few years is that the vulnerability is slowly being reduced, which is another word of saying there's some disintermediation going on, and the public sector, whether it's through the ECB Eurosystem, whether it's through the EFSF or other bilateral loans, is carrying more of the risk. So I think the risk is slowly but surely being moved into the public sector, which is probably more resilient in taking the hit. But clearly the sentiment and confidence crisis is not over, and every summit is accompanied by large expectations, which sometimes in the past have been disappointed.
I mean, I would probably disagree that they have large expectations. It seems to be summit after summit after summit where nothing really happens. But, I mean, if there was a major credit event within the Eurozone, how do you reflect that in the rating? Do you have to adjust the way you rate countries and sovereigns to something new and something different that wasn't there before?
Well, I think the issue of confidence crisis is very difficult to predict and therefore very difficult to rate. We believe that if Greece were to leave the Eurozone, for example, that the social and political and economic consequences for Greece would be truly calamitous. And observing that from the outside, if anything, would probably enhance the willingness of other program countries to pursue their current programs, especially since they've already incurred much of the political cost. It would also probably stimulate the generosity of the core Europeans, trying to portray the Greek exit as a true sort of exceptionalism case. This would be a positive spin to it. Of course, you have the risk of contagion. You have the risk of sort of deposit withdrawals on the periphery accelerating and maybe leading into outright bank runs, in which case then we would hope and expect that the ECB would react very much with force to stem that.
The death of the risk-free asset was a subject that we've looked at this morning here at the conference. Rating agencies obviously are deeply involved in defining what a risk-free asset is. How have you adjusted your business to take into consideration that sovereign is now a credit?
Well, sovereign was always a credit. So you had risk-free is sort of a rule of thumb. There's nothing is risk-free in life. Not even the UK or US Treasury bonds are risk-free. The risks are just much more sort of reduced compared to the risk of a Greek government bond, for example. We're reflecting this in our ratings, which are relative rank orderings of likelihood of default, and the US bond that is sort of considered the safest asset has been downgraded last year. So it's still a very safe, in the greater scheme of things, a very safe investment, but it's not risk-free in the strictest sense of the word, nor is there one.
So it's more about relative risks than absolute risks.
It is absolutely about the relative risks.
Very good. Just a few words on the borrowers. I mean, you're an old friend. You've been here many times. What do you think about the conference? And are we going to see you again next year?
Well, whether you see me again depends on whether I'll be invited again. But surely, I think this is an important event to also get a sort of a sense of what the market sentiment right now is. This may not have been as important in the past, but right now, where markets are driven on sentiment to a large extent, this is a great opportunity to take the pulse.
Excellent, Moritz. Thank you very much.
Thank you.
I have with me now Paul Young from Citi. Paul, the Eurozone crisis, is it really not true to call it a crisis anymore because it's been going on so long, looks set to continue? Is it really just the new normal?
Hi Richard, thanks for having me today. I don't think I would ascribe to that notion. It's clearly been with us for going on close to 2 years now in one form or another. But I do think it's sort of reached a new level, and perhaps some of the hardest decisions now have to be made. They've been able to effectively, take care of things over a period of time, perhaps a haphazard way, but it's happened. And I think you are approaching both just levels, investor sponsorship, ratings, and frankly, am I going to be part of this or not part of it? Sort of questions and scenarios that do make it a crisis, because I think actual sort of fiscal sustainability is really being challenged. And there's an old saying that the markets can stay far more rational than you and I could stay solvent. The question is, in this case, who's solvent and who's irrational. I think the shoe's sort of on the other foot now. So I do think we're at a very important tipping point, and I do not think this is the new normal. And I hope it's not.
Us too. When you're taking high quality or even high yield corporate borrowers on roadshows, how do you approach the sovereign question? Presumably the investors always want to know about the relationship to sovereign risk of the country in which these borrowers are domiciled?
I think there are two parts to that. One is there's obviously in certain countries there's a sort of a linkage or sovereign ceilings or sovereign floors, as the case may be, linked to they're obviously corporate ratings and then there are financials. I think financials tend to have a lot more correlation with the sovereign rating. Corporates have decoupled before, and we are seeing a fair amount of decoupling at the moment in certain geographies. I think a lot has to do with the institutions' questions. Mix of business. Are they completely domestic? Do they have strong overseas businesses or cash flows? And that sort of comes into the equation. But I think everybody is cognizant that in certain industries you do get dragged to the sovereign level. In others you can decouple, mostly in corporate space, and it is a risk factor on the horizon. And in some instances it's subject to not so much debate, but it's more, what if or how do I deal with this? I don't think there's any debate that they tend to move together, and different investors will take different views.
Has the way that you run your business, you run your team, changed as a result of all of these dislocations in the markets for the last 5 years? Yeah. I mean, would you recognize how your business was run 5 years ago?
Well, I think that there are some, obviously very dominant themes in terms of the way we run our business and cover institutions, the type of markets we access, and what sort of the bread and butter of what sort of keeps an institute flowing. But I'd say there are two or three things. One, we ourselves in the industry have changed enormously. So we can no longer run our business in the same way that we used to. And that's particularly driven around costs, around regulation, compliance and things of that nature. If you go back to sort of 07, take away, a huge swath of structured business, et cetera, you could sort of see the implications there. So that's on the one hand. On the second hand, obviously we all have to deal with new banking regulation, which is making every single financial institution in the world think about what they're doing, how they're doing it, should they be doing it, where should they be doing it. We face that question every single day. And then the third thing is, if this is the new normal, which I hope it's not, do we have sustainable business models in the context of the new normal? I would say that we're all going to go through some sort of gut-wrenching process over the next 2 to 3 years. I could see the industry, operating at, from here to that, 15, 25% less personnel, just because the metrics just aren't there to justify the returns on capital. Within our business mix, obviously structured credit is, a much smaller part of the business today. The sort of basic institutional flows, providing liquidity, things like that are becoming much, much more dominant, and in a way more challenging because, we've shrunk balance sheets as an institution, as an industry. We have higher capital requirements, so inventory control becomes much more, or flow becomes much more prevalent. So I think we're all going through a lot of challenges at the moment, and our customers and our clients are going to feel that in one way or another as well.
You've been to many global borrowers over the years. Do you enjoy coming to this conference? Do you think it has a role still? And
No, absolutely. I think you always get a fantastic audience. I think the last couple of years there have been several dominant themes that I think have everybody very much engaged. I think the panels are well thought out, and you have a great roster of speakers. Personal institution, we'd love to see costs come down, but I'm sure you hear that from everybody. But I guess you have to pay for quality at times too. So we do enjoy it, and we do enjoy being a sponsor.
Thank you. Thank you very much, Paul. Thank you very much. I'm here now with Mudassar Malik from BMA Capital in Karachi, so one of our emerging market delegates. Mudassar, what brings you so far to come to this, which is obviously a majorly European conference? What's interesting you about the event, and why are you here?
Well, I think this conference holds a lot of fascination for people all over the world, and I think particularly now with all the risk and uncertainties surrounding Europe, and Europe being such a huge global issue, really people from all over the world are focusing on what happens and how things and how policymakers take decisions moving forward. I think Coming from Pakistan, obviously Europe is a very strong trading partner, and that is one of the reasons why we are here to try and understand how the European crisis might impact on investment and flows in Pakistan.
I know you have many clients in Pakistan. You're one of the largest asset managers in the country, if not the largest asset manager in the country. Do your local clients ask you about Europe? Do they feel what's happening in the Eurozone is relevant and important to the performance of the assets you hold for them?
Our business is principally domestic focused, but nonetheless, I think with the degree of interdependence that financial markets have today, really asset prices in Pakistan and in Asia you've seen moving in tandem with what's happening in Europe or in response to what's happening in Europe. Having said that, most of our clients who are pension funds in the domestic market who hold bonds and stocks, they've had a very good run. Pakistan is an exception, I should say, this year, because the market is up about 13% against, that's the MSCI Pakistan index, as against, say, MSCI Europe, which is negative 7%, and MSCI Emerging Markets, which is negative 3%.
There is still a small element of political and other risk in Pakistan. It seems to be edging forward slowly to an improving situation. How do you read what's going on in the country politically and economically?
Well, I think investors, when they focus on Pakistan, whether they are domestic investors or international investors, they have a high degree of risk aversion. I think Pakistan as a country enjoys many of the opportunities and challenges that you find in other emerging markets, and particularly in Asia, which are a large population, a large domestic market, and a growing domestic market. But Pakistan has one difference, which is that I think 5% of the worst news is projected 95% of the time. And so, if you like, the bubble of pessimism has been growing larger and larger. And that in itself is a big opportunity, I think.
Have international capital flows to Pakistan continued to fall, or are they beginning to pick up, or are you seeing a different alignment of the way capital is flowing, less perhaps from the West, more from China and other places in Asia?
That's a very interesting question, and I think we have seen obviously on the portfolio side, on a year-to-date basis, there have been net negative capital flows, although they're small, but they're nonetheless in the negative territory. If you look at USAID and DFID, which are the two largest aid agencies around the world, they have made Pakistan their single biggest priority or one of their largest programs. For example, DFID's Pakistan program is the largest in its portfolio. So there is a sense that the international community feels that Pakistan is a country that cannot be ignored, and that governance and some of the other infrastructure issues and social indicators need to be brought up in order to help Pakistan get to the next level. I think that we also see that the domestic business community, which is a huge stakeholder, has continued to invest, and so there is a sense that despite all the problems which we have now, perhaps are problems that we had 5 years ago, and so you have to get on with business.
And what about the security situation? Of course, unfortunately, this is what we see on our TV screens and our terminals here in the West. Is it improving? Is no news good news?
Well, interestingly, I was reading an article that was written by Goldman Sachs, and I was not aware of this, but they were talking about the insecurity in Pakistan and rather the lack of security. And funnily enough, again, this is talking about the fact that the worst 5% of the news is projected 95% of the time. This Goldman Sachs article was talking about the fact that the homicide rate in Mexico is probably higher than in Pakistan, and perhaps at par with Indonesia and some of the other Asian economies. Having said that, of course, the security concerns are not unwarranted. And so I think it's important that when you look at investment flows and when you look at the confidence indicators, you have to understand that by and large investors are perturbed about that, and therefore the focus of government policy and I think the international community has to be on what are the things that need to happen that change this perception.
Excellent. Manasseh, thank you very much for joining us. It's been a pleasure as always.
It's a pleasure being here. Thank you so much.
Okay, I'm with Brian Pascoe from HSBC. Brian, welcome.
Thank you.
The Eurozone crisis is something we've been talking about a lot today. It's hard almost to call it a crisis. It's been going on for so long. Is it a new normal? Do you think it's a new reality for the markets that will last for a few more years?
I think in many ways it is. I mean, we've seen things drag on now for quite some time, and I think we don't really have a clear light at the end of the tunnel in terms of resolution around the banks and a way to solve the sovereign debt crisis. And clearly we now have some minor issues developing around the growth prospects in some of the emerging markets, and obviously that's an important engine of growth for the global economy overall. So I think we do have a new paradigm to deal with. That said, in many ways the markets are functioning normally. We've seen very, very healthy levels of emerging market supply this year. Corporates have been able to hit the market on a very, very regular basis, and some of the, clearly in the public sector, the better quality sovereigns and supranationals have also had a good degree of success. So I do think that we've moved into a new world order where headlines and volatility are very much the order of the day, but I think the market's shown quite a level of adaptability in being able to cope with it.
I've spoken to quite a lot of your I imagine they're your clients, the major issuers, sovereigns and corporates today. All of them said that there's been a flight to quality, and of course they are fine and all of that. But each of them has said that they've really changed the way they approach the markets to something where the windows of opportunity, generally speaking, are much smaller. They have to be able to react much faster and be more creative. From a banker's point of view, how do you the way in which you work with clients, I mean, presumably it's become much more time sensitive. Is that something that you see to be continuing, and what does it mean for the way in which you run your business?
Certainly preparation is much more important than it was in the past. I think you're absolutely right. You have to be prepared and ready to move into very, very narrow windows of opportunity. I think sort of on that basis, direct engagement with investors through roadshows and teleconferences is a very, very important tool for helping to prepare for those transactions, to know what the investor feedback is around potential transactions and appetite for the credit, and how much investors are really willing to invest in different market circumstances. So it's definitely, I think, an environment where you have to be better prepared, where you have to be more flexible, and where borrowers really can't afford to wait for that extra day or two of market and spread performance if they feel that things are going to get better, because you never know what's around the corner.
Do you find, I mean, a lot of the borrowers that I've been talking to have been saying that they've changed their internal decision-making processes, so they can get approval to issue. Well, they can approve it themselves rather than having to put it to a board. Do you see that in the way with clients, that they've changed the speed at which they can react, that they understand this, and now that they can be much more sensitive and reactive to the opening of funding windows?
I think in most cases they've been forced to do so because of the nature of the market these days. But I think you still have a number of clients, and probably the majority now, that have shown that level of understanding and sophistication and moved to that faster decision-making model. But I think you still have those who feel that the crisis is about to end, spreads are about to develop on a much, much tighter trajectory, and they can afford to wait. But that said, we're definitely starting to see a liquidity pinch from banks across the credit spectrum, even in some cases for better quality credits, although I think for the very, very best names, bank liquidity continues to be abundant. But certainly in our client base, we are seeing a slightly less complacent view on the need to access the capital markets sooner rather than later, and clients are definitely getting prepared to do that.
Do you think that when you're road showing non-sovereigns, is there always a question from investors about the state of health of the sovereign under which the corporate is nominally domiciled, or are investors really looking at global corporate names and saying, well, the credit story is not really tied to the sovereign, so we can look at that in a different way? I mean, I suppose what I'm saying, are investors becoming more selective as well?
Yes, I think it's case by case. I mean, we've seen a good level of issuance from peripheral corporates this year. When market conditions are better, in many cases there's been a decoupling also, where the corporate credit spread trades much, much tighter than the sovereign itself does. And so I think that's been quite a healthy dynamic, and that investors are willing to look through the sovereign in many, many circumstances to see the true intrinsic value of the corporate credit. That said, clearly the more domestic credit profile in terms of the revenue generation, in terms of EBITDA, etc., that any corporate client has, the more of an impact the sovereign rating and the sovereign correlation will be.
And finally, the global borrowers, it's I think our 22nd or 23rd year. You've been here a number of years. What do you think about the conference, and should we look to see you next year as well?
We'll certainly be back. It is an excellent forum, I think, to get together with clients and peers, and to listen to some of the speeches and presentations as well, and get to test the pulse on what's going on. So hopefully long may it continue.
I hope so too. Brian, thank you very, very much.
Thank you.
I'm with Arnold Fuller from DZ Bank. Arnold, welcome.
Yeah, thanks, Richard. Thanks for the invitation to speak here.
The Eurozone crisis has been around for so long it can hardly be called a crisis anymore. Do you think it's the new normal in the markets?
Well, if you take it from the everyday feeling, it's a new normal. But then again, ultimately, it won't help us if this will last forever. So I guess we all would be more than happy if there would be a solution to the crisis, one way or the other. But then again, it feels like that we are going into ever deeper cycles, and that there is no stopping to it at all, unfortunately.
As a German, a European-centric bank, do you feel affected you? I mean, is this something you live with every minute of every day, or has it become so much there that really you can carry on your business without too much worry about it?
Well, actually, DZ Bank has profited from the crisis. I mean, since post-Lehman, we have gained market share, we have gained mandates from issuers which we have not worked together beforehand. Reason being is that obviously we are Eurocentric. We have a natural investor base which goes beyond the, let's say, top line in every country, and that is more and more looked after by issuers issuing euros. So from that perspective, we have gained from it. But is it a healthy gain? Ultimately, probably not.
When you talk to issuers, I mean, a lot of the corporate and sovereign issuers that I've interviewed today were saying that they've changed, maybe not the size or the pricing of the issues they had, but the way and the speed in which they have to access the market. Do you see that with your clients? I mean, have they changed the way in which they approach the markets over the last couple of years?
You mean the borrowers? Well, the borrowers certainly have to be much more prepared. In order, particularly frequent borrowers, they normally are prepared, but if you want to access the market, you have to really meet those narrow time windows. They open up and close much faster than in the past, and that is a tricky thing and the challenge to issuers of whatever kind, be it SSA issuers or be it banks or corporates. Corporates being now the safe haven, but all the others, yeah.
Safe havens, we all love our.
Yeah,
we all love
have to smile as well.
Yeah, exactly. Safe havens. Everything's a safe haven. Has the way that DZ Bank organises its own business in terms of the DCM space, has that changed as well over the last few years? I mean, do you have a different organisational structure within the DCM business, or do you just work harder and longer hours?
Well, I mean, the latter has not changed. I guess I guess I can speak for the entire industry. The way we are organized, or we organize the business, we have put a focus organizationally on corporates just recently, where DZ Bank, since our DNA, it is not in our DNA to be the lender to the blue chips in Germany, but then again we have this instrument of corporate Schuldscheine, which becomes ever more important to the, let's say, those corporates which are underneath the DAX 30 or whatever. That is a focus which we put emphasis on. Then again, if it would be just up to me, I would love to have a fully operational MTN desk. We put emphasis on the private placement business. Because as markets, as we just discussed, are not open at any time, occasionally you have a chance to address different pockets of demand, which might be typical private placement, or in the case of German savings banks or co-op banks, coming from a certain sector, and then you have 100 million here, it's lightly structured, and so on and so forth. So critical mass is growing there as well, as a reflection to the fact that benchmarks cannot be issued at any time.
And are individual bankers having to be more being able to do multitask rather than specialising in one area? Do they have to have a wider skill set as opposed to a narrower one?
Well, I guess that I mean, well, you asked in the beginning whether it's a new normal. I guess we need to that takes a bit of time. Whether ultimately we have to consolidate, the number of borrowers gets smaller and smaller, and that whether we have to be experts across asset classes, or whether we can still stick to the normal organization of having an SSA desk, having financial coverage, covered bonds, and corporates. So I guess that's ultimately too early. I look back on times where I'd been covering everything, but nowadays we have still this focus, and I guess it's too early to respond.
Too early to tell, rather like the French Revolution.
Yeah.
But final question: the global borrowers. We've been, I think, 23 years now. You've been here before, I know. Do you enjoy the conference?
Yeah, I enjoy it very much. I mean, those conferences are platforms to network, to meet with issuers from further away than just from the neighboring country. You have more opportunities to meet amongst the seniors. So it's a networking platform, and as such, we like it. And although we are pretty young as compared to the 23 years you just mentioned, only 5 years DZ Bank being a sponsor here, but since then we are a constant sponsor, and may that not change.
Thank you very much.
Okay.
Real pleasure. Thank you very much.
Bye-bye.
I'm with Christopher Marks from BNP Paribas. Christopher, welcome for a start.
Thank you.
And the Eurozone crisis, well, it's been going on now for so long that it's really not a crisis, it's the new normal, isn't it? Don't you feel that we've had to adapt to it, and it's simply going to continue?
I think it's a process of incremental policy experimentation. So it's hard to say, it's probably not fair to characterize it as the new normal, but we're progressing and integrating new tools and structural changes which over time will make the Eurozone stronger and frankly more viable by international investors.
And I think most of the people that spoke today do not see a quick end to this. They see that the process of incremental experimentation will continue. Is that what you see in your business, that your customers, your clients are really believing this is going to continue for quite a long time yet?
They do, and it's not a bad thing, because we are approaching a generational shift in terms of the size and appropriate breadth of public balance sheets, what is the scope and the flexibility of financial institutions, and how to ensure as well that both of those elements support corporate growth in the real economy in Europe. The experimentation in the Eurozone it's a critical one for European populations and the economy, and we have moved at lightning speed. If you think even over the past 18 months, to put in place new tools and policy measures that over time will have to be implemented. So it's been remarkably fast if you compare it to some of these kinds of changes in other continents.
But I mean, the risk of substantial dislocation is still there. It may not have changed, it may not be more risky than it was a year ago, but clearly when you're talking to your customers, your clients, they understand this, and they must have changed the way they run their funding operations to take this into consideration. Have you seen that, and what is your role as a bank in advising them on how to do this?
I think the question is exactly well put, because again there's a diversity of users of the capital markets. Some have more frequent requirements and therefore have had to adapt themselves very quickly in terms of timing, in terms of different tools, use of new markets. Other clients are having to wake up to the realization that the composition of their funding will look very different in a few years than it did some years back. In Europe, as you know well, we've been very dependent on the bank market. This is a situation that will not return in the future, regardless of the eventual stability of the capital markets. And therefore we'll move incrementally towards a composition of funding that looks somewhat more like that of the United States, where there's a heavier reliance on the capital markets. It's a radical change for a lot of treasurers, and progressively they will have to explain to their own management about these new realities.
And what does it mean for the way that you run your business in DCM, and how has that changed? Presumably if we're going more to the capital markets from corporate treasurers and others, that's a good thing, but the type of bankers that you need to have, the type of people, the balance between the different aspects of the business, how has that changed, and how do you see it changing in the next year or two?
I think particularly if you look at the points of real tension and stress within the Eurozone, which is precisely the attachment point between public sector balance sheets and financial institutions, and the support that's provided in different ways over time. For the next 3 to 5 years, this will be probably the critical area of thinking for thoughtful bankers, and therefore the teams that we put together to address these questions are both public sector specialists as well as financial structuring colleagues. And it's actually the combination of these two that form really the most effective advisory teams. Because there's no precedent for a lot of what we're doing, and therefore everything has to be created anew, and the teams have to reflect that.
Final question. The Global Borrowers, I think it's 23 years we've been going. BNP have been a sponsor for many years. Do you enjoy coming here?
The conference every year, and again, all of the dislocations in the market facilitate this, it not only never loses its relevance, it becomes more relevant every year. So no, it's a great satisfaction, and it's a rare forum to meet many of the clients and colleagues.
Well, thank you very much. Thank you for coming.
My pleasure. Thank you, Richard.
Thank you.